Welcome to Motley Fool Money. Thanks for being here. I'm your host, Chris Hill, and joining me in studio this week from Motley Fool Inside Value, Joe Magyer, from Motley Fool Income Investor, James Early, and from $1 Million Portfolio, Mr. Ron Gross. Good to see you guys.
Howdy, Mr. Chris.
We got a big show. We're going to break down the latest earnings from Amazon, Facebook, Exxon Mobil, and more. For Super Bowl weekend, we'll talk about the business of football with ESPN business analyst Andrew Brandt. And as always, we got a few stocks on our radar. But we begin this week with the big macro, and Ron, really two big stories this week. The jobs report that came out Friday morning, 157,000 jobs added, unemployment at 7.9%. But earlier in the week, the GDP, which I think surprised a lot of people, down slightly, 0.1%, first drop in 3.5 years.
Yeah.
What of the two, which do you think is more impactful?
That's too much economics for me, Chris. I'm sorry. I'm sorry.
Impactful a word? Is that real?
Yeah, I just said it.
Okay.
I think the GDP headline is more troubling than the reality. It was largely based on the fact that federal spending for military was down 22%. Now, we can't sweep that under the rug because military spending is a big part of our GDP. However, I don't think that is a trend, at least not to that magnitude. So I think signaling that perhaps we're falling into a recession, which is the definition would be 2 quarters in a row of negative GDP, I don't think we're there. So I think that's a bit more headline risk than anything else. The job numbers were just good enough to say to the markets, hey, we're not falling back. We're creating some jobs. Unemployment hasn't moved, but the Fed will continue to ease, so don't worry.
Free money!
The gravy train continues.
Free money
Stock
forever.
market likes that.
James, what do you think?
Yeah, at least the shrinking economy was kind enough to produce more jobs. I mean, that's the main thing. I go with the jobs number, not with a GDP number.
Joe?
Yeah, and to zoom in, what I really liked was the upward revisions from November and December on the jobs numbers. Definitely a positive sign.
Shares of Amazon hit a new all-time high this week in the wake of fourth quarter earnings. Earnings were much lower than expected. The company lowered guidance for 2013, Joe.
It cannot be killed.
I was just going to say, and yet the stock hit an all-time high.
Its skin is Teflon. Yeah, I'm an Amazon bull, but even I would say that was a surprising response. What the market really liked, and I did too, was that gross margins were the best in a fourth quarter since 2001. They jumped 4 percentage points year over year, which in retail land is phenomenal.
Yep.
But they fell short on guidance. They fell short on volumes. Third quarter volume grew about 40%. It was only 32 this quarter. I mean, all in all, still a great quarter. They're growing twice the rate of overall e-commerce, so strong, but not amazing.
Ron, how much of this is Jeff Bezos, the CEO? It seems like he is increasingly one of these almost superstar CEOs that, to the point Joe is making, he's going to get the benefit of the doubt.
Yeah, I was going to call him benefit of the doubt Bezos, Teflon Bezos, wherever you want to go.
Benefit of the doubt Bezos.
You like that?
Yeah.
I think it's a lot of it, but also Amazon is a great company, and much to his credit, obviously. But it's producing amazing numbers. It's got a really bright future. So they're willing to both give him the benefit of the doubt and to sing the praises of a great company.
Joe, when you look at the stock at an all-time high, do you get interested, or does it just scare the hell out of you?
I think Amazon's going to hit a lot of all-time highs. I don't think that's necessarily a bad thing, but I personally...
They're going to do it without you as a shareholder?
No, I am a shareholder, and I'm going to be a long-term one, but I would hold out for price below $260. I mean, it's a volatile stock, so you could afford to be a little bit patient and pay, instead of an insane valuation, just a wacky valuation.
You got a pretty specific number there with 260.
I'm a nerd.
I'm impressed.
Exxon Mobil's fourth quarter profit rose 6% to just shy of $10 billion, James. Nearly $45 billion in profit for the entire year. Those are just astronomical numbers.
But the stock was flat, Chris. You know, we all want excitement in life, but sometimes it just doesn't work out that way.
At least they regained the title of largest company.
They did, but it was kind of a blah quarter. I mean, refining profits were up again. And if you're new to oil companies, they basically make money 3 ways: by producing oil, by refining oil, and then by oil price rising. So oil prices rising. Production, however, dropped to a 3-year low, and that was the big thing: is where are these guys going to get more production? They're going to have to go out and buy more sources of oil.
And yet, Joe, this is among other things, this is a stock that is an absolute dividend machine.
Yeah, they paid $80 billion in dividends over the last decade. So when people compare Apple and Exxon in terms of market cap, there is that other thing you might want to keep in mind.
James, does the fact that they keep paying out these dividends, does that get you more interested than anything on the production side?
Of course it does. I mean, I love dividends. And I wouldn't bet against an energy company long term. We're just going to need more and more energy. It's a company I wouldn't bet against. I'm just not pouncing right now.
Yeah, James is right that they're definitely going to struggle to replace the reserves they have. And Exxon, because it's an older company and very well managed, has low cost reserves. So their margins are very high, but it's going to be really tough for them to kind of not just replace what they have, but do it in a way that's is nearly as profitable as what they've done in the past.
Facebook's fourth quarter results had something for both bulls and bears. For the bulls, revenue came in higher than expected, earnings per share higher than expected. But for the bears, Ron Gross, operating margins fell from 48% to 33%. That's a huge drop. And at least in terms of the stock, the bears are winning this week because Facebook shares down about 5% for the week.
Very true. My fellow value investor, Joe Magyer, is going to jump down my throat for this, but I'm going to say I don't think you buy Facebook because of this quarter's margins, next quarter's margins, or even the quarter after that. You buy it if you believe Zuckerberg can take 1 billion users and create an empire. Investors call that optionality. Joe probably calls it ridiculous, but it is it is the reality of if you want to be an investor in Facebook at 50 times EBITDA. Or 13 times sales, the valuation just doesn't make sense. You have to believe in many different options.
And you believe
in the future. We have a section of our portfolio for high growth companies with optionality, and we have a small position as part of that allocation.
I'm in a limited position to criticize after just saying that I like Amazon, which is wildly expensive.
2 times sales versus 13 times sales, so I'll give you that.
Yeah, well, at least you guys have, profits. But what I would say with Facebook is that what troubles me in terms of the optionality argument is that payments and the non-advertising revenue coming in was flat year over year, which is not what I would expect for a company that has a growing user base and in theory is coming up with new ways to monetize that base. Now they can come up with more ways to monetize it on advertising, and I think they have and they're going to keep going to, but that's something I would watch.
And the margins took a beating. I mean, the mobile ads are costly.
Yeah, but they're also investing significantly for the future, not unlike Amazon has done, but I don't think Zuckerberg gets the same benefit of the doubt.
Yeah, I was just going to say, I mean, it's a slightly unfair comparison only because Bezos has been running Amazon and running it more successfully for a much longer period of time. That said, it does seem like we're looking at mirror images in terms of the stocks where Facebook is doing better than expected but takes the margin hit and the stock gets punished. Amazon, seemingly every bit of news from their quarter was bad, with the exception of the margins. And as you said, Ron, Teflon Bezos gets the benefit of the doubt.
But the fact that we're talking about optionality is a warning sign, to me at least.
Okay. Yeah, well, it's
we
also
have to use a word like that.
Yeah, and when we're talking about a specific number, I like looking at gross margins specifically because they're the closest thing on the income statement to reflect a competitive advantage. So when you see that widening, that's definitely a good sign. And people saw that with Amazon, and they got excited. And when it goes in the other direction, they get scared.
This week, mercifully, at long last, Research in Motion finally unveiled the new BlackBerry Z10 smartphone. And, Joe, I think it says everything about what people think of the smartphone, that shares of Research in Motion down more than 25% this week.
I think you said it all.
I mean, you have people out there in the media saying, look, this is make it or break it. It's all riding on this one device. That seems a little bit like hyperbole. And yet, when you look at the fact that their market share globally when it comes to smartphones in the last 2 years has gone from 20% down to 5%. That's when I think, you know what? It really is all riding on this phone.
Yeah, I think so. If this is not a big hit, they're going to need to just sell the company. Otherwise, it doesn't really have much of a future independently. I mean, the BlackBerry 10 is going to be a big hit with CTOs because it's got superior security requirements. It's definitely a better hit if you're trying to sell it to the CTO. But the problem is, same thing like we've had at the Motley Fool, where originally we were told, we're not going to support iPhones or Apple devices. But when we all just showed up with them, they eventually had to come around with that, and Android too. And so now the company supports, these other platforms, which are lower security, but ultimately that's what consumers and employees are demanding, and enterprises are having to adjust, and that's definitely a negative for BlackBerry.
And our producer, Matt Greer, was the lone holdout at the company.
He was.
He had a BlackBerry, and then finally it was our IT people coming to him and saying, you know what? We're not supporting BlackBerry anymore.
We're not supporting Mac anymore.
You're going to have to pick a brand new phone.
And they're changing the name, right? To
they are
Black,
changing the name.
which
Yes.
is,
That makes sense.
That doesn't make sense. It sounds like it's like Sony changing its name to Betamax. I mean, the BlackBerry, you think of this antiquated phone that it's on its way out. It's like they're. I mean, I guess what else did they have going, right?
Right, exactly.
Yeah.
Yes.
If you're going to bet big.
Starting next week, it will officially be BlackBerry. The ticker symbol is changing from RIM to BBRY. Ron, I'll just give you the last word. If nothing else, BlackBerry seems like it's potentially a value stock. Do you look at it that way, or do you just want no part of this company?
A value stock has to be in an industry or a specific business that is not in perpetual deterioration for it to work. Otherwise, it's just a trap, and I think this is a trap.
Coming up, one of America's worst CEOs is retiring, and boy, are we going to miss him. Stay right here. This is Motley Fool Money. Welcome back to Motley Fool Money. Chris Hill here in studio with Joe Magyer, James Early, and Ron Gross. Guys, kind of a mixed bag quarter for Harley-Davidson. Higher sales of motorcycles in the U.S. and abroad, but lower fourth quarter profits on lower revenue. James, I know you're a gearhead, so what'd you make of the quarter?
Well, earnings were down 33%, and arguably they did everything well except sell motorcycles. It still wasn't that great. Harley does have something like half the U.S. motorcycle market, but its customer base is aging, which is a pretty big problem, even though it's gaining market share and expects to ship more motorcycles the next quarter. So long term, I am not a bull. I used to have a motorcycle. Last time I rode one, I got hit by a school bus, actually.
Is that true?
It is true. It is true.
Who was at fault?
School bus was.
Okay.
Yeah.
Was this recently?
No, this was years ago.
Oh, okay.
I totaled the bike, but I'm okay. But it was not a Harley.
I can't believe you got hit by a bus.
He
Literally.
didn't see me, and I was going the speed limit too.
Ka-ching.
Yeah.
Wow.
No, there's this statute of limitations. It was a school bus. Trust me, it sucks. Or not a statute, whatever. Some kind of a capped liability or something.
Where were we?
All right. Anyway,
We'll edit this out in post-production. Don't worry.
Back to Harley for a second. James, we were talking about this before the show. When you look at Harley's competition, it's almost entirely comprised of private companies, Viper, Triumph, etc. Whether it is Harley-Davidson or just any company in general, does that put a company at a disadvantage? Because it seems like I would, if I were working at Harley, I would feel slightly disadvantaged, despite the success that the company has had, that their competition is working under a different set of rules.
well, yeah, the private company is not in the fishbowl that the public company is. Public company might have a little bit better access to funding, which could be an advantage, but private company is going to be more nimble. But with Harley, they've got so much market share. It's probably less of a factor with them than with some other company, for instance.
Shares at a 5-year high. Are you interested? Or?
I'm not interested.
On Thursday, the U.S. Justice Department blocked Anheuser-Busch InBev's proposed $20 billion purchase of Grupo Modelo. When the news broke, shares of both companies fell between 5 and 10%. But, Joe, shares of Constellation Brands fell more than 20%. The beer companies really getting hit. First, what is going on with Constellation Brands that they're getting hit that bad?
So to keep it simple, they were going to acquire the full stake instead of the half stake they have now for the rights to import Corona into the U.S. And the Corona is a huge brand in America and incredibly profitable. So that's why they're getting kicked in the teeth.
We talked about this earlier. The Justice Department really, over the last few years, seems to be taking
flexing
its muscles when you consider this, when you consider the fact that Anheuser-Busch's growth over the last any number of years has come primarily through acquisitions. The AT&T T-Mobile purchase. What do you make of that?
Well, as kind of a free markets guy, I'm not wild about it. But it's not surprising that you're going to see consolidation in these industries because they're low growth, they're capital intensive, and distribution is a big deal for beer. And we've talked about this on the show before, but the economics of making beer are really terrible. It's fun if you're a hobbyist, but if you're trying to sell it, it's really tough to do. And that's why these guys keep merging together. And this is actually, good news for some of the other players out there, like, Samuel Adams or Boston Beer Company, a lot of the private labels, or Molson Coors. But as a consumer, I don't know that we're realistically any better off because this was denied.
I know this just happened on Thursday, but do you think
challenged?
Do you think that this ultimately goes through and Constellation Brands gets made whole?
I think this could go through. Unlike the AT&T T-Mobile deal where there were just going to be too many concessions, I think there could be a lot of asset sales here to make it happen.
Yahoo's fourth quarter earnings came in higher than expected, but shares down around 4% this week. Ron, Marissa Mayer, the relatively new CEO, I think she's getting high marks from just about everyone. But I'm wondering, even though the stock is up under her tenure, it seems like she's doing about everything she can, and it's still not enough to move the needle.
Yeah, well, I give her an A++ for changing the perception of Yahoo. She's really done a fantastic job, and she's perhaps stemmed the tide of some deterioration. But we don't have a really good understanding of where we go from here. She said she wants Yahoo to be a powerhouse in mobile, and she wants to use customized content, use partnerships, but there's no real meat on the bones there. The business, it's a very competitive business out there. So how they make this happen and how they monetize it all remains to be seen. So, I mean, she's doing a great job so far, but she's got a lot of work to do.
That was profound.
Thank you.
How do they make a dent in mobile, Joe, when they don't have an operating system? They don't have a device. What do?
Pass.
Pass?
Yeah, I'll pass on that one. No, I mean, they're in a very difficult position. I think one thing they talked about on the call, which is smart, is that they're trying to just improve the user experience at the point where they actually touch customers. They don't actually power their own search anymore. That's done by Bing and Microsoft. And that's smart, but ultimately they are going to have to move further upstream towards the customer and either own more relationships or more of the technology. And right now, it's tough to see how they're going to do a better job on the technology side. So it comes down to how are we going to make more money on the relationships? And again, like Ron was saying, we need to start seeing some traction there.
Ron, just last thing when it comes to Yahoo. We talked earlier about Facebook, and it appears, I'm wondering if you see it this way, but it appears that both of these companies, Yahoo and Facebook, are essentially limited in their regard. They're not obviously in the same business, but it seems right now that both of them are sort of in this box where they are sort of nice businesses, they're doing what they can, but the growth opportunities really are limited for both of them.
Well, it's hard to see, to be honest with you, and this might be a subtle difference, but I think Yahoo has to reinvent itself, and Facebook is still inventing itself, and there is a difference to those two things.
CNBC, Forbes, and Businessweek magazine are just a few of the business media outlets who named Aubrey McClendon as one of the worst CEOs of 2012. This week, Chesapeake Energy announced that McClendon will retire as CEO on April 1st. And James, I'll just go to you first. Shares up about 10% when the news broke. How bad is this guy?
He's bad, Chris. I think everybody agrees. He's sort of had the board in his pocket, and he's run the company as he wants to. I think he sort of owns the town where Chesapeake operates anyway. It's just how he is. I don't think many of us here at Motley Fool have a lot of sympathy for him. So for the better.
Many being zero.
Yeah. I think this is one case where activist investing really did a good job here, as Carl Icahn and Southeastern Asset Management came in and demanded changes to the board and really created these philosophical differences in quotes that Aubrey said is the reason he was leaving. That's a nice euphemism for saying it's time for him to go. And, he's still taking $53 million with him, I believe, as an exit.
That's his package?
Which kind of doesn't sit well with me.
I feel terrible for that guy.
Well, again, I don't feel bad for him, but just from an ego standpoint, it seems like it is a little bit of a kick in the teeth when the stock pops like that once you're walking out the door.
Yeah, well, I'm sure he'll get
a
by.
few more,
For that kind of money, kick you in the teeth?
Yeah, you can, actually.
All right, Joe, James, Ron, we'll see you later in the show. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. I'm Chris Hill. Joining me in studio once again, Joe Magyer, James Early, and Ron Gross. Guys, before we get to the stocks on our radar, one bit of news for any college students out there who are interested in investing and finance. The Motley Fool's blog network has started a campus challenge whereby any student interested can write for our blog network on behalf of your school. We've just kicked this off. We've got students from Georgetown, University of Texas, Cal Berkeley, Tulane. You can earn money, and to find out the details, just drop an email to blog@fool.com. That's blog@fool.com. We just started the Campus Challenge. It runs through March 7th, and it culminates in a live taping of the Motley Fool Money radio show at the Kogod School of Business at American University in Washington, D.C. So
exciting.
Yeah, we got to dress up for that
We'll be there.
All right, Ron Gross, a stock on your radar, and we'll bring our man Steve in to hit you with a question.
All right, Steve, I've got an arbitrage opportunity for you in American Greetings, ticker symbol AM.
Sexy.
There is a acquisition offer on the table from the CEO and his family for $17.50. The stock is 16. So the street just doesn't want to recognize and close up that gap. You can make 9-10% easily in a few months. If the deal falls through, I think the stock is still worth 22, so you'll do even better.
Steve, question?
Where do they stand in the e-card business? Because if there's one thing I love, it's a good e-card.
They have multiple assets in that regard, some for free and some where you pay.
James Early,
So
your
hard to
stock?
shop for an e-card. I don't know if I can top quick money like Ron Gross is offering, but I will go with Cisco Systems. Sometimes you just get tired of recommending the same regular dividend-type stocks. So this is a tech stock, which is kind of cool. A 3% yield, 75 to 80% market share or thereabouts in switches and routers. This is the core business. Internet use continues to grow. This company is disciplined in its use of cash and over 30% upside by my model.
Steve, question about Cisco Systems?
What can we learn from the flip cam debacle?
Sometimes acquisitions don't go over so well, Steve.
And sometimes you just keep making bad acquisitions.
Yeah,
As a longtime Cisco shareholder, yeah, we've seen that movie over and over. Joe Magyer, we got about a minute left. What's your stock this week?
Chubb, ticker is CB. It's a conservative, well-run insurance company. They cover a lot of different things on the business side and personal. They pushed through some pretty strong price increases yesterday, which is great, which has me excited about a lot of insurance companies. Chubb in particular had a terrible quarter because of Hurricane Sandy, but overall it's a phenomenal insurer over the long term, great business. Selling at an attractive price right now, 1.3 times book. Not a great price, but an attractive one for such a good business.
Steve Bruno, what do you think?
What's the possibility that beach properties will be uninsurable in the next 10 years?
It's definitely getting very expensive to insure them, and if you're thinking about buying beach property, factor in the cost of that.
Steve, American Greetings, Cisco Systems, Chubb, you got a favorite?
Or would you like to meet James's model?
I don't know. I might have to go with American Greetings. It does sound like an arbitrage opportunity, which is just glorious.
Very nice.
And as Steve mentioned, he's a sucker for a good e-card. Joe Magyer, James Early, Ron Gross. Guys, thanks for being here.
Thank you, Chris.
That's going to do it for this edition of Motley Fool Money. Thanks again to our guest this week, Andrew Brandt, business analyst for ESPN. Our engineer is Steve Broido. Our producer is Matt Greer. I'm Chris Hill. Thanks for listening. We'll see you next week.